If you already own one global market fund and you want to diversify further, don't add more of the same. Add things that behave differently. This is day 24 of Money Made Simple 30 Days to Start Investing. This is where people get confused. They already own a global fund, it holds thousands of companies across countries and industries. Buying another global fund doesn't really diversify you, it just gives you the same thing twice. It's important to check the overlap between funds. Real diversification means adding investments that move differently. So here are the main options to look at. First, there are regional or thematic funds. These are optional enhancers, not essentials, and examples include emerging markets, small cap funds, or specific sectors. They're still shares, but they have slightly different risk and return profiles. Think of these as adding flavor, not changing the structure. The most common first diversifier is bonds. Bonds are basically loans to governments or companies. They usually move less than shares, fall less during crashes, and reduce overall ups and downs. They won't grow like shares over the long term, but they can smooth the ride and reduce panic. Next is property, usually through REITs. These invest in real world assets like offices, warehouses, and shopping centers. Property behaves differently from shares. It can provide income and adds exposure to physical assets. It still goes up and down, not always at the same time as global markets. Then we've got commodities like gold. Commodities don't produce income and they don't grow like shares. Their job is protection, especially during crisis or high inflation. You can also include cash-like investments such as short-term bond or money market funds. Not savings accounts, but investments designed to stay stable. These reduce volatility, give flexibility, and help people stay invested during tough markets. These are about control and peace of mind, not growth. The bottom line is you don't need multiple global equity funds, dozens of ETFs, or constant tweaking. More funds doesn't automatically mean more diversification. So, one solid global fund plus a few assets that behave differently is usually enough. Diversification isn't about complexity, it's about balance and purpose. See you tomorrow for the next episode.